Thank you for having me. I'm from Albaresmarsal. We're the #1 restructuring firm in the world. If you read about the largest global restructurings in the world, you often see our name attached to them. Companies like Lehman, recently FTX, and now in China, Evergrande. So we sort of operate behind the scenes, but when you observe restructuring, we're there. However, it's a misconception that that's all we do. That's actually only a small part of our business, about 25%. 75% of what we do is helping companies to create value and to outperform their peers. That effort is important to restructuring, but it's important also to ordinary, everyday companies. Albaresmarsal is a unique company as consulting firms in that we're not just consultants. We have a lot of people that work with us that are former executives of companies and a lot of functional and industry experts. And that allows us to really help work with management teams to create value. But no matter what, we always bring a hands-on operating approach to companies to help them actually realize change. I should also state that we do have a practice here in Korea. We've been here more than 10 years. My colleague Dee Chung is here in the audience today, so if you have a chance at the lunches or cocktails or anything, please feel to seek him out to understand what we do here in Korea. I didn't introduce my name. My name is Jaimsdubo우. So I lead Albaresmarsal North Asia. I myself specialize in helping more underperforming companies and distressed companies to realize value and make change. Often I do that through taking CEO or chairman or CFO roles to actually become part of the management team to help companies. I've lived in Asia more than half my life. I speak fluent Chinese. I speak some Japanese. Unfortunately, I don't speak Korean yet. It's something I need to work on, but I'll try. So I should have had this started, sorry. So today I'm going to talk about two things. I'm going to talk about activist investing and its impact, and I'm going to talk about how value creation works in practice. Excuse me 1 second here, sorry. Get the right slide. So activist investing has continually grown over the years. You'll see here that from 2021 to 2023, in Korea alone, it's increased 150%. And while the perception of activist investing is mostly negative, companies are fearful of activist investors, feel that they're very short-term, and they harm their ability to operate. That is in fact not proven by the data. Most market participants are realizing now the benefits of activist investing and change under pressure. And the benefits include improved governance, more balanced boards, and increased dividends to shareholders and shareholder value. Ultimately, the goal every time is to increase the share price, which should be in everyone's interest. The graph on the left here shows the percent of Korean companies that have 1 times or less interest coverage. It's been increasing over the years, reaching 17.5% in 2022. My understanding of the latest data, it may be as close to even 40%, as the graph on the right shows. That's astounding that 40% of companies that are listed have only 1 times interest coverage. That's a clear marker, that there's a lot of underlying pressure in the Korean economy. Of course, the Korean economy is not alone in that. We see that around the world today, especially as interest rates have risen. So I'm going to take a look at some data from activist investing. Because activist investing in Korea isn't yet very mature, there's not enough data to really draw conclusions here. So I'm using data from Europe where it's very active, and that can give you an idea of the impact of activist investing. So this chart here shows the activist investing targets by sector. And you can see that industrial, consumer, and financial companies have historically been the greatest targets. It's interesting that these industries are the ones also in Korea that I think make up a big portion of the Korean economy. So that makes Korean companies in particular themselves probably current or future targets. So what do activist investors demand? This chart shows you here what the demand of each activist investor here. You can see the largest by far is governance, boards, independent boards, policy, things like that, dividend policy, etc. Historically, improved governance, effective M&A, and efficient capital allocation, usually focused on issuing dividends, is the primary target of activist investors. Recently, as you can see in the chart here on the right, growing, operations, strategy, and ESG are becoming increasingly important to activist investors. So this chart here shows the performance of the companies relative to the benchmark sector. And this is what I was speaking about earlier when I showed the data shows targets of activist investors often outperform their peers. According to here, gains of 5 to even 20% over their peers are often achieved. And so there are some benefits. You'll note that consumer and industrial companies, in other words, companies that make and sell things, have the biggest impact, and financials as well. You'll also note the dip in 2020. Studies show that when companies are targeted by active investors, it's easier to work together to realize actual value when the markets are good and the markets are rising. When there's a lot of distress in the market, like there was in 2020 during COVID, companies are facing too many issues to be able to deal additionally with the demands of active investors, and actually usually that causes worse performance. But I would say that's only in the most extreme negative markets. Studies show that even in slightly underperforming markets, companies can still achieve value, as we'll see in the next part of the presentation. So what kind of returns are achieved? One thing that's very interesting here, as I showed earlier, governance is probably the biggest target of activist investors, and it does achieve some performance return, 5.5% versus its peers, but the returns are actually lower than operations and M&A. So initiatives focused on better operations or strategy or more effective M&A, what that usually means is either not doing a particular transaction or trying to do a particular transaction that the activist investors demand. Those have a bigger impact. And very interestingly, ESG has had historically almost no impact. Now, I think that might be slightly misleading because companies that focus on investments in ESG tend to have a longer payoff time. So that probably ignores a bit the benefits that wouldn't come immediately in the company, but might come later. I'd also note that I think companies are getting better about reacting to activist investors and getting better about improving value when they're attacked. And you'll see even all the things are converging here, and even ESG is starting to really improve. So I think there's also an element here of the market maturing and getting better at implementing ESG value. So what can we take away from what I've just said? So first of all, despite negative perceptions, activist investing typically has a positive impact on companies, at least on the share price. Industrial and consumer companies have the greatest potential for value creation. And finally, very important point, if companies want to avoid activist investors, they don't need to wait for them. Working on improving shareholder value early and preemptively will help companies avoid activist investors. So now we're going to take a look at how value creation is realized in practice. As I said earlier, this is something that I've been doing for more than 25 years now. So I hope it's relevant to you. It's less financial in focus, but much more operational. It's more about the how. How do we realize value in the real world? So if there's one thing you should take away from this presentation, is that the word restructuring is not a dirty word. People are afraid of that word. They think of distress, restructuring, but restructuring is not. As I said earlier, 75% of our work is for healthy companies, and these companies simply want to increase shareholder value and outperform their peers. Many of our clients are, in fact, private equity funds or banks that introduce us to companies to help their customers and their investee companies improve their performance. These efforts almost always generate positive results, and they're best when done early. So what is value creation? It actually seems mysterious, and people kind of wonder how it's done. In practice, it's really not at all. It's about getting the simple things right. So one of the first things that's very, very important is stakeholder buy-in. And stakeholder is broadly defined. It includes management, board, shareholders, employees. It even includes outside parties like customers, vendors, and government. If the sort of ecosystem that a company exists in, and very importantly, if the chairman and CEO of the company are firmly behind making positive change, then positive change is very likely to happen. In fact, that's almost all you need. Things just happen right when all the environment around a company is pushing in the same direction. And if you don't have that, it's almost certain to fail. So that's a super critical thing. The second thing is, I would say, clear-eyed analysis. What I mean by that is really looking objectively at a company. What is it doing right? What it is doing wrong? Which divisions are its stars? Which are underperforming? And taking a very hard look with nothing off the table in terms of making change. Also, alignment of economic interest is important. So incentivizing the management and with compensation that aligns with the goals helps a lot. This defined corporate governance is really important. That means having a board and knowing the board's role in overseeing the process, having clear KPI for the management team, and having regular measurement of that KPI. In some cases, we have that measurement daily. Sometimes it's weekly, but at most monthly. Daily would be, for instance, a fast-moving company like a retailer or something like that, where you can have daily input on how the company is doing. Other key elements, and this maybe comes from my own experience, one of my key mantras is never have more than three major priorities for a company. I've had clients that have had a list of 60 priorities. When you have 60 priorities, you have no priorities. So it's really important to be focused on what we're trying to achieve, and it's very, in turbulent markets like our earlier speakers just discussed, in the kind of change we have with geopolitical economic pressures, it's very easy to get distracted and confused, and it's important to be focused. Second is to have a culture of change. It's important to, as I said earlier, to have the ecosystem supporting change, but it's also important to talk about it a lot, to have at all levels of the organization, to have the organization focused and ready for change. It's a very difficult thing for anybody to face change, and I think that you need to recognize that and constantly, at all levels of the organization, even the most junior people, get them ready for that. And finally, super important, and I think something that most companies forget, when you're transforming your performance, people often focus on what's going wrong. You need to focus on what's going right and who your best employees are, your best subsidiaries, because most of the value of the company comes from their best businesses, as many of you would know. You're probably going to get 80% of your value from your best divisions. And if you put all your focus on the 20% that aren't doing well, you neglect the important ones. What's more important is to try and achieve cash flow and capital from your underperforming and devote that cash flow and capital to your best performing to even help them grow. So it's very important not to forget what your golden goose is. So here I want to talk about, just give you an idea of some real life examples of how you actually achieve change. The first one I want to talk about is a retailer that we worked with. This retailer was underperforming its peers. Most of its stores were losing money. And overall, a very interesting metric, its inventory turns was only 1 time per store per week. For those that know retail, you should be selling product 4 times and above, and best sellers 8 to 10. If you're selling your product on average 1 time per store per week, that's excessively low. So one of the first things we noticed was an obvious problem where management, despite being experienced, wasn't really keeping up with the latest trends of retail, and many of them actually, this is an Asian market, many of the managers were brought in from other markets where they were experts in their market, but not necessarily experts in Asia. So one of the first things we did is simply take the number twos in most of the divisions and at the C-suite, and elevate the number twos to lead their divisions. That change alone, if we had just done that, would have already had a huge impact, because the energy level and innovation entrepreneurism changed overnight for a company that required that. Second, we made immediate sort of improvement in changing the company from a push method to pull. What that means is they were designing product and selling product that they thought the consumer would like, trying to be very creative, looking at what's going on the runways in Paris and models and things like that, rather than looking at customer data and what does the customer actually want. Now, it sounds easy, but to change from a push to a pull, you have to really get good data, and you have to change every process in the company so it all orients to the customer. That took some time. It took a few months. But after making that change, and plus helping improve their e-commerce platform, the company was break even within only 11 months, and by the end of 2 years was highly profitable relative to its peers. So the summary here is this particular transformation was all about creating a high-energy, customer-focused company. The second one is a trading company. The trading company had a history of making large capital investments that were poorly conceived. It was a very successful company in most of its businesses, but these large capital investments, when they did lose money on those, were eating up a lot of their other profits. And the other thing they had was way too much debt. So this company, the clear thing was governance. So we put in a new board with more independent board members and experts from various parts of the economy. We implemented new governance and controls on investment processes, but we also wanted to support the employees managing the capital investments, so we aligned their compensation with the outcomes that we desired. Second, we exited loss-making businesses and contracts. And finally, we restructured the debt, and that wasn't just reducing the debt and reducing the interest, but actually matching the debt to the type of business with trade finance and things like that. This all resulted in, it took some time, this took about 3 years, but at the end of the process, the company was massively improved in cash flow, and today is very successful. So the theme here, was all about capital investment and balance sheet operation. The last one, the consumer products company, again, a company where it had some very good subsidiaries, but other subsidiaries that were making losses. They also had poor accounting, so that their assets and their inventories were overvalued. And when you have overvalued assets and inventory, it makes your decision-making process not necessarily sound. And so we spent time to understand, which companies were doing well, which ones were not. We improved the accounting and the analysis, and then we separated it into what we call a good co and bad co. We sold the good co off in parts, formed the bad co off in parts, and then formed the good co into a solid company, eventually attracting strategic investment so that company could succeed. And the theme of this one, again, this was probably one of the more distressed one, but this is really about shrinking a company to get to its core business that it could do well. So the point here is every situation is different. When activist investors come to companies, or even when you want to transform on your own, there is no one solution for any company. It may be balance sheet, it may be operations, it may be design, it could be a number of things. But the point is, while no one approach works, what's required, as I said earlier, is stakeholder buy-in, clear governance, clear-eyed analysis, a strong, united management team, and one I didn't mention earlier, but communication throughout the organization about what you're doing. So I wanted to give some idea of the difference of characteristics across regions. The reason I did this is, we operate in virtually every country in the world, and we always hear that, for whatever reason, in our country things are different and you can't really transform companies too easily here. And that is not untrue. Every country has different barriers and different challenges. And you need to understand those challenges and figure out how to deal with them. And actually, I know, because I've worked with them, the companies in Korea are very adept at understanding the challenges that they face. In fact, many of the largest companies have a chairman and chairman's office staffed with people who are very capable of making change and understand the market they deal with. But every market is slightly different. I think you guys will all understand very well the Korean market. I think in my own experience, I think one of the things that's often missed about the Korean market is a very deep bench of strong, professional, often engineering-trained executives who are energetic and capable and work hard, and that alone is a huge value. But of course, there's also difficulty with labor and other regulatory things. But one thing Korea does have is very, very reliable courts and legal processes. The U.S., on the other hand, while it's a very mature market in its capital markets and whatnot, and has very straightforward labor resolution, as you probably would all know, it's full of lawyers. And it's very, very challenging to do almost anything without going through a legal process, and extremely expensive and slow because of that. So the challenge in the U.S. is very different. China is an interesting market. China, where I've done a lot of my work, people often think of it as very difficult to get anything done. It's almost the opposite. There are so many rules and restrictions that companies are very adept at how to navigate those, and are entrepreneurial and creative about how to make change. It is difficult because the banks are less supportive. Banks aren't very comfortable with restructuring, although they will often help extend loans. And of course, it's also difficult with labor and labor laws there as well. And then finally, in Japan, which I'm less familiar with, frankly, I'm not an expert in Japan. I've done a couple of projects there. The issue in Japan is the really expectation of lifetime employment, and currently with a very improving but still low interest rate, it's difficult to finance transformations. Positively, recently, as you're probably well aware, Japan is making some regulations to encourage companies to restructure and improve their balance sheets. So I'll give you my final thoughts, and what I'd like you to take away from this presentation. First of all, obviously activist investing is on the rise. Many companies have asked me how to avoid activist investors. I mean, frankly, it's very difficult because they've raised their funds and that's what they're out here to do. But the best way to avoid them is have good performance. And I know that's easier said than done, but that's what needs to be done. Second is, despite the challenge of activist investing, the data at least shows that it can increase shareholder value if you figure out how to partner with them and achieve some change. And then finally, preemptive valuation is always the best approach, and not just to avoid active investors, but if you do it early, you often have more resources in terms of capital and flexibility versus waiting too late when those things can become constrained. And then finally, creating value is definitely not easy, but in my experience, it can be done in every situation as long as you have a disciplined, thoughtful approach and people working together. So thank you very much, and I appreciate you having me today.